Management Skills Part 3, The Real Game of Cash, Stocks and Credit. At around 11 o'clock at night, a man was standing in the parking lot of a shopping mall. There was a new phone in his hand, but instead of happiness there was a slight fear on his face. He had not bought the phone with cash. Everything felt easy while swiping. But while returning home, only the credit card bill was revolving in his mind. The fear begins right here. When money does not go from the account immediately, then an expense does not even feel like an expense. And the curiosity is that how does this very small habit become a big debt of the future? In part 2, we saw that the rule of money changes at every stage of life. Skill in young age, planning in middle age, and safety in later age become important. We also understood that saving is not the purpose of life. Money is not just for accumulating, it is for making life better. But without discipline, this very money can become stress. Life cycle theory teaches us balance. Do not completely kill today's happiness, but do not leave the future in the dark either. This is real money management. Now the story moves forward. If we have come to know when to save, when to spend, and when to invest, then the next question comes. In which tools should the money actually be kept? When does cash come in use? Can stocks really create wealth? And is a credit card a help or a trap? This part of Money Management Skills explains key financial instruments to us. These are those tools with which we do daily dealing, but often do not understand their real power and danger. The simplest tool is cash. Cash does not mean just the notes kept in the pocket. This is that money which is immediately under your control, which you can spend immediately. Cash gives comfort. Whether grocery has to be bought, a bill has to be paid, sudden travel has to be done, or a small emergency comes up in the house, cash becomes your first help. But cash has a weakness too. If all the money remains easily available, then expenses also keep coming out easily. Convenience many times weakens discipline. That is why understanding the difference between a checking account and a saving account is necessary. A checking account is for daily use, from where bills, card payments, and routine spending run. A saving account creates a little distance. The money kept there remains a little saved from daily temptation. This distance looks small but comes in very useful in changing behavior. In part 1, we talked about the financial brain. The brain takes decisions in impulse. If money is in front of it, then it says let's spend it right now. If that same money is in a saving account, then it will have to be transferred before spending. This very small pause gives you a chance to think whether this expense is a necessity or just a mood. Therefore, the smart habit is to keep limited money in the checking account for daily expenses. Keep the remaining money separate in emergency, goals, and investment buckets. When money lies in one place, a person considers it available. When money is divided into different purposes, then the brain tries to save it. Cash is necessary, but wealth is rarely made from cash. Cash gives safety, not growth. Inflation can slowly reduce the purchasing power of cash. This is the reason why, after basic liquidity, a person has to understand investment tools. Because just saving money is not enough. Putting money to work with time is also necessary. Now let us come to stocks and shares. Many people understand the stock market as a casino, and some people assume it to be a quick rich machine. Both ways of thinking are incomplete. Buying a stock means that you are taking a small ownership part in some company. If the company grows and profit increases, then the value of your share can also increase. A company needs capital to expand business. Sometimes it takes a loan. Sometimes it issues shares, and investors become participants in its future growth. But return is not guaranteed in a stock. If the company does not perform well, the management takes wrong decisions, or the market condition turns bad, then the stock value can fall. This is the reason why patience is necessary in the stock market. Some companies take time to grow. Profit does not come immediately, and the price keeps changing daily. The first mistake of new investors is exactly this, that they assume daily price movement to be success or failure. Today green, so happy, tomorrow red, so panic. But a business does not change daily. The market price can change every day, but the real journey of a company is made over years. An investor has to understand the difference between noise and signal. The second mistake is making an investment looking at a famous name. If some company is famous, it does not mean that its stock is always a good investment. Many times, famous companies are already expensive. Everyone knows about them, therefore future expectations have already been attached to the price beforehand. Recognizing a growing company is not easy. Just liking a product does not make an investment decision, right? Factors like sales, profit, debt, competition, and management have to be understood. But every individual cannot analyze individual stocks. Therefore, for many people, diversified funds, index funds, or broad market exposure can be more practical. Diversification means not putting the entire money in one single company or one single sector. If a loss happens in one place, the rest of the portfolio can give support. In part 2, we too had learned this very thing, that investment should be kept simple. The mix of liquid assets, safe instruments and growth assets should match with your age and goals. If you need money in the next 6 months, then putting it in risky stocks can be dangerous. But for a long-term goal, a place can be made for growth assets. The biggest question of investment is not return, but time and risk. When is the money needed? Upon how much fall will you panic? And do you really understand the investment? Now the story comes to credit. Credit is a very common financial instrument of modern life. Home loan, education loan, business loan and credit card all come from the world of credit. The basic meaning of credit is using money today and returning it in the future. If this tool is used in the right place, it can improve life. An education loan can increase skill. A home loan can give housing stability. Business credit can help in growth. But uncontrolled credit can cause financial damage. The most visible tool is a credit card. This small plastic card or digital limit makes you feel as if you have extra money. In reality, that is not extra money, it is the advance use of future income. Today you swiped, tomorrow you will have to pay the bill. A credit card gives convenience. It can be useful in online payment, emergency purchase, rewards, transaction record and short-term liquidity. But the danger of a credit card is also just as clear. When the payment is not deducted from the account immediately, then the pain of spending gets delayed. The brain feels that the expense has not happened yet. This very delayed pain can pull you toward more shopping, impulse orders and lifestyle upgrades. If you pay the entire bill before the due date every month, then a credit card can become a manageable tool. But escaping the trap of minimum payment is necessary. Minimum payment sounds like relief. But interest keeps adding up on the unpaid balance, and slowly a small bill becomes a big burden. Credit card interest generally can be very expensive. Therefore, using a card like a loan is dangerous, especially when the expense becomes bigger than the income. Banks and card companies make earnings from fees, interest, late payment charges, and the merchant ecosystem. Meaning, a card can look free but can turn out expensive for a careless user. Credit card reward points should never be the reason for spending. Spending 5,000 rupees extra to save 100 rupees is not financial intelligence. If you have a credit card, then the first rule is that do not treat the limit like income. The limit has been given by the bank, you have not earned it. The second rule is that pay the bill fully. If you are not able to pay fully, then this is a signal that there is a problem in the spending system. The third rule is that keep fewer cards. Many cards, many due dates and many limits together increase confusion and temptation. 1 or 2 cards can be practical, but taking a new card behind every store, airline, shopping app or cashback offer can become a risky habit. If you are an impulse spender, then removing the credit card from the phone wallet is also a useful step. When a little friction comes in payment, then the decision will slow down. The pause rule of part 1 works here too. If some expensive item is to be taken, wait for 24 hours before swiping the credit card. If the next day too that thing feels necessary, the budget allows and you can pay the bill fully, then take the decision. Otherwise it was not a necessity, it was an impulse. Now imagine that some person is already in credit card debt. Because of fear, guilt and shame, he stops opening the statement. But debt does not become small by ignoring it. It has to be looked at by making it sit in front. Total outstanding, interest rate, due date and minimum payment, everything has to be written down. If high-interest debt can be finished by selling an asset, then a practical decision might have to be taken. But if the spending habit did not change after paying off debt by selling an asset, then the debt will return. Therefore, debt repayment is not just a payment plan, it is a behavior plan. Reducing expenses, decreasing card limit, setting automatic payment and stopping new debt is necessary. Talking to the bank and understanding the repayment option is also better, instead of getting stuck in the cycle of missed payments and penalties. Communication many times can do damage control. People use methods like debt snowball and debt avalanche too. Someone finishes smaller debts first for motivation, someone finishes high-interest debts first for savings. Whatever the method, the goal is one. Credit has to be kept a tool, it must not be allowed to become the master. Because when credit takes control, then the income does not remain yours despite being yours. Cash, stocks and credit, all three are neutral tools. Cash is safe but growth is low. Stocks can give growth, but there is risk. Credit is useful, but in misuse, it is a trap. Money management does not mean fearing the tool. It means understanding the purpose of the tool. A knife helps in the kitchen, but can also give an injury in wrong use. The real lesson of this part is exactly this, that financial instruments amplify your character. If there is discipline, then the tool will create wealth. If there is impulse, then that same tool will create a problem. If you kept cash in buckets, understood stocks with patience, and kept credit under control, then your financial journey can be strong. But if cash is lying without direction, stocks are bought on tips, and a credit card is running the lifestyle, then danger is building up slowly. Now the story stops here, but the question becomes even deeper. If financial tools are understood, then how will we understand risk? Because in every investment there is a story of return, but the risk hidden behind it often appears later. In the next part, we will open this very truth of risk and return. And perhaps then it will be understood that earning money is necessary, but saving money, growing it and saving it from being lost is an even bigger art.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.